Hi everyone, Evelina from Arcadier here. Today on Inspire, we have Anuj Jain, co-founder and CEO of StartupO. StartupO is a Singapore-based assessment and investment platform that discovers promising startups in Southeast Asia and connects them to seed funding through its partner funds and its venture building network of market experts. It puts businesses through a structured 10-week online process that involves a data-driven and transparent evaluation by a global expert community. Hi, Anuj. It's great to have you. Thank you for joining us today. How are you?
Thank you very much. I'm very glad to be here. I think it's a great initiative, guys. So looking forward to our interaction today.
Wonderful. Well, we're super excited to have you speak. So let's just get the ball rolling. Can you share with us a little bit about what you'll be talking about today, and then you can just jump right in.
So you've given a very interesting introduction that, as you mentioned, that we are investment and assessment platform based out of Singapore. Now, StartupO platform and fund approach is a pretty unique one, which aims to identify all the promising and authentic entrepreneurs who are full-time, with skin in the game, with product ready, and with early traction, where we believe that if you're walking the authentic walk, then you deserve a fair chance to get connected to capital and global networks that are available on our platform through the fund, as well as a community of 66 global experts from 14 different ecosystems that we already have. But at the same time, when I was discussing with you, there are thousands of aspiring entrepreneurs in today's world, people who are midlife career changers, young students who are coming out and don't want to join the traditional industries, as well as a lot of homemakers who are full of ideas, but actually the journey from idea to startup is quite a tumultuous one. And sometimes it's costly, it has opportunity cost and everything else, and pains, of course, associated with it. Now, StartupO platform is very, very focused on, out there product ready startups, if I may say. But looking at this opportunity of even helping aspiring entrepreneurs, we just recently started a virtual online, offline hybrid sort of an incubator called First Stop. And this is also partnered with the Spring AMP program here, where the whole idea is that if you are possessed with an idea, then do not go and waste time in this inefficient ecosystem. You can directly understand the gist of how to get your idea to a startup level and create something, because this is the best time to be alive, where you can create. But just because you can create because of the low cost of technology does not mean that you should create, and hence you need to understand certain basics so that you don't have heartburn and a hole in your pocket in that scenario, because especially in Singapore, it's a very high cost location to try things out. So First Stop is aimed at a different target audience. And today's presentation, as we discussed, is more targeted at people who are at early stage of ideas. And this is a new product that StartupO platform is offering. So I'm pretty glad if you can pull up the presentation, we perhaps go into it right away and tell you certain commandments for people who are at very, very early stage of ideas, that what are the things you should test yourself. So with each slide, you should give yourself, yes or no, whether you know that or not, and count your score. And typically what we say, if you are less than 4, then you really need to go to the drawing board. Between 4 and 7, then you need to, sort of connect with some experts and understand and get out in the ecosystem and talk to your customers of sorts. But if you're 8 to 10, then I think you need to, immediately get involved with communities of angel investors and founders and other partners. So don't waste your time, and you can take a jump. So this is more 10 commandments of sorts for very early idea stage people. And I hope it helps you to refine your thinking of should you or should you not jump the gun right now. In today's world, a lot of information is available on Google. And when you search, there are tons of e-courses and everything. This is a distilled version of, what 10 commandments could be for somebody who's not able to sleep in the night because you're possessed with the idea but don't know what to do about it. So be very clear about people who are already doing startups may have gone through these things already, but this is for a typical, totally different audience. So if you look into the second slide, which will give you some, can you move on to the second slide? Yeah. So this is a self-audit framework, and I believe a lot of people spend a lot of time in understanding. You need to see a objective mirror of sorts. Should I quit my job to take up my startup idea forward? I mean, I meet so many aspiring entrepreneurs who ask these questions. And what are the things I need to focus on to increase and enhance the probability of success? Should I build it, or can I build it? But if I can build it, should it be built in the first place? Is a very, very potent question in today's world, because you and I can discuss any idea today and create an app or a platform doesn't mean anything unless you are able to take it to its commercial feasibility. And finally, is there a structured approach to mitigate risks, which are aplenty in this journey of creating a startup from something that you're pretty convinced about? So if you go to the next slide, and you will see from here onwards, there will be certain questions that you will see at the top of the page, and then of course in the orange bar is the essence of what must do, and finally at the bottom these are a kind of a little bit of a tip, insider tip kind of a thing, that what you should be focusing on. So first question that you must look into, whether you say yes or no to that, is can you simplify and put your startup idea on one page? Now, let me just tell you, when I moved out from the corporate world where we were presenting to the board level 60 to 100 slide presentations and a lot of Word documents to make decisions, when I moved into the startup world, first thing I realized that you need to have very clarity of thinking is the key. And with this lean canvas approach, which I presume by now, everybody knows so much about it, but it is very important not to just learn the framework, but to have clarity of thinking, to put in these 9 boxes, what exactly are you trying to do? And whole idea is to go lean. Once you're lean, you waste a lot of, don't end up wasting time and go around the circles in explaining what you're trying to do. So, as I mentioned at the bottom of the slide, that this is just the start to get on the treadmill. But I think the whole fat and the whole thing that we usually think in an old paradigm needs to be drilled down to one page. To your self-audit and scoring model, just say, do you know about Lean Canvas? If yes, have you put down the whole business plan succinctly onto this one page? If it is yes, then give yourself 1 score. If it is no, then give 0. And then we can move on to the next one. The second one, the beauty of the lean canvas, if you really look at it, is, it kind of forces you to think whether you're solving a real problem, or it is just looking woolly, or who your customer personas are. More importantly, what's your unique value proposition, and something which is usually underrated, what's your unfair advantage, apart from the fact that you know the metric, you have the cost drivers and revenues all covered in the slide 1. Once you have that understanding, a lot of times people, after even having done a good lean canvas or a business plan, have not validated the problem, which essentially means things seems falling into 3 categories. That is it a vitamin, or is it a painkiller, or is it a heroin that you're creating? Most of the times, a lot of new ideas come out of their personal passions, and it seems like I seem to need it, or my wife has said that she needs it, or my friend has asked for a particular thing. I think the whole world needs it. So there's not validation from any credible sources, except from people who tend to say yes most of the time because they love you. So the whole idea is, what exactly is the problem that we are aiming to solve? And at least to begin with, because it may pivot as we go along, but a lot of startups spend too much time creating the solutions, finding a problem. And that's a very important thing here, because if you start with a solution in mind, that I can create something which is sexy and interesting, doesn't really mean that you're solving a problem, right? So start by validating the problem first. And frankly speaking, just get out of your beer friend circle and your family, because they are your well-wishers and they would love to see you as an entrepreneur and a successful one. But you have to go to what I say a second degree connects, who could critique your idea, who could poke holes into what you're trying to solve and actually get a sense through a scientific process. So if you read even the book, The Lean Way, you will find the way to conduct interviews with your second degree connects to understand whether there is any problem that exists in first place. And don't start building a solution just because there's a grant available somewhere. And then you find out after 6 months of heartburn and everything that, hey, nobody is actually clicking or downloading or coming as a customer, because frankly, if the problem is not felt strong enough, then it's a difficult start to begin with. So score yourself on whether you have validated the problem by going out there and meeting the customer personas that you have put down on your lean canvas and say, have you got a real problem in hand? Are people willing to even pay for that that you're creating? Once you have got a yes for that, give yourself another 1. If not, then say 0. The third is, hey, we assume you have a business plan. We assume you have validated the problem, but you may be just another solution out there in presence of multiple alternatives, multiple other solutions that other people are also creating, because in today's world, creating is rather relatively much simpler and lower cost to iterate. And hence, you have to focus on things like what's your unique value proposition. Now, uniqueness of the way you're tackling a problem is something very, very key. It's one of the 4, which I tell you in the end, one of the 4 key things that even venture capitalists look into it, that is there an angle out there which is uniquely tackled, even if the problem that you're solving is being catered by other alternatives and other solutions available. So this, you can only refine it. There are various models and there are various frameworks available to find out what's your unique value proposition, but you got to become a serial pitcher. You need to have your anchor pitch, you need to have your elevator pitch, and you need to have your proper 10 to 15 minute pitch in perhaps some demo days and one-on-one meetings, sorted out very clearly. And once you do that, it helps you drill down to the essence of what you are unique about. And that's where we say angels are everywhere, or investors are plenty. Money is becoming a commodity, literally. But intrigue them. If you can't intrigue them, if you can't catch the attention in your first sentence or in a 2-minute elevator pitch, then I think it's going to be a very difficult one, because people don't have time in today's world, and everything after a while from an investor or stakeholders perspective start looking similar. So you need to really work on uniqueness and your pitch at this juncture. Now, if you have already got this sorted, then give yourself another mark. If not, then say, I need to go back and work on it, but right now give a 0. If we go to the next one, this is something which is most underrated, and what we see after even investing in 10 companies last year, that domain expertise or some sort of a inside info or understanding of a network or let's say access to expertise is something of a it is something of a how do you say it's an advantage. Sorry, I think the slides are moving up and down and so on. Okay, sorry, I go back. So having an insider know-how and access to expertise, and especially networks in today's world, is considered a most underrated sort of an asset that a team could have. After investing into 10 companies last year, we realized a lot of founders who have really made it to the top of the funnel have deep domain expertise, and by virtue of being out there and hustling, have access to certain expertise and networks that are helping them move ahead faster, because nothing trumps traction in this game. And as I always say jokingly, that either you need to think hard, what's your unfair advantage for doing this business, which essentially means if somebody like anybody else would start that business because you can create anything today, technology is not a differentiator to a large extent, why would that guy or the other person would not be able to do the business with the similar finesse, or will not be able to gain traction as fast as you would? What are those factors? So really think about those. Is it defensible, intellectual property that you may have? Sometimes even that is not an unfair advantage in today's world, but still, do you have that, or do you have a particular sort of information or access to network that you know that makes you a bit differentiated and hard to copy as you go along. As I mentioned, that if nothing else, then you have to count on your mother's blessing, and Mother's Day was just yesterday. So be very careful about this, because a lot of people jump into a new idea without realizing that anybody else, even, it takes a lot to start from the beginning to scale up, but you realize if you don't have any unfair advantage and it is easy to copy, then somebody with deeper pockets would come and kind of copy it and waste your efforts into the whole thing. So do assess. Your self-audit is very important at this juncture. And if you don't have, it's okay, but you have to be aware that you need to have some sort of unfair advantage to begin with, either with your knowledge, networks, or expertise, or some sort of technology breakthrough, which keeps you ahead of the curve, which is very important. Time is the most important thing at this stage, and hence the secret sauce. Now, there are a lot of startups which are very excited with the technology and what technology can do about in today's world. But the magic, especially in Southeast Asia, lies in how do you go to market? How do you commercialize your ideas or your product to the next level? There's a lot of intellectualization happening in this ecosystem. A lot of people are also chasing the vanity metric of what is the potential of this new products and technologies that are being created. But the whole idea, and I think Stephen Blank, if I'm not mistaken, have said very interestingly, you got to get out of the building. A lot of time is spent in coding and talking about investing and going into networking events. But are you going enough? Are you going out enough to meet multiple customers every day, learning like a sponge, getting the feedback from the market, tweaking the product, pivoting if need be? But the whole magic happens when the rubber hits the road. It's not created in accelerators or co-working spaces or the whole sexy ambiance that the ecosystem provides. It's out there. Go out, talk to the customers, and have a methodology of assessing where you're going wrong. Why is it not exciting or energizing people if that's the case? And keep tweaking till the time you arrive out there. It can never be created in a boardroom or sitting with your mates sipping beer. You have to spend, especially the founders, have to spend a lot of time with the customers to make sense out of the whole game. So conversations beyond your inner circle and yourself is the key in this. Again, in terms of self-audit, give yourself a score if you have met at least 30 to 50 customer personas, whatever it is, to figure out, and you pitch to at least 30 or 50 times to figure out what's working and what's not. Yeah. And I guess this is another area which is a big white space at early stage, not for any other reason, but there are a lot of assumptions involved at this stage of building a model which seems like driven by passion, but there are tons of assumptions. And hence, we see, and the third factor is, of course, a lot of founders are pretty tech savvy, but in terms of the finance or financial part of the whole business, because business is not about creating a product. Business is about selling a product at a profit so that the stakeholders that are part of it, everybody wins at the end of the whole game. And the fundamentals of traditional businesses, whether it's a restaurant or it's a factory or it's a multinational company or a bank or a technology startups, are just the same. So nothing changes just because you're a technology startup. And you hear stories in the media that people who don't even have revenue, they have just got, Series A, Series B. Don't get fooled by the whole idea. It is a strong financial understanding and projections, and even for companies who are not making revenue, there has to be a financial model of monetization. So you like it or you have not liked your Kumon or other maths classes, but you need to understand your maths. Now, terms like, burn rate, your cost of acquisition, your active users, your paid conversions, your life cycle value of customers, the metrics like famously known as ARR or called R, needs to be there in the plans if you're going and talking to your stakeholders to energize them. A lot of times we see people say, hey, I've got an idea, I can make a product, but how are you going to sell, or how the cost drivers are going to play a part in the plans that you have to scale your company, and people actually fall short time and again. Even some of the startups which are out there for some time, actually this is one of the areas which requires maximum help for young founders. So look into it. If you are unaware about these terms that are written at the bottom, or you've not come across, or you've not built your financial plan and projections with right assumptions, then give yourself a 0 today. But you need to be aware that you need to work on this maths pretty soon. The next one, I think, is, it's not only the pitch, but the whole model has to make sense. And as I promised earlier, these are 4 things that if you don't learn anything on these through this presentation, just see this one: 4 pillars of investment, and put yourself in the investor's shoe. If some company comes to you, you would definitely look into whether there is a team. Team is very important. Team, and a complementary team is even better. That who is going to execute? Because it's all about execution. Ideas are plenty. Everybody's thinking everything similarly. Do you have a unique value proposition, which we covered earlier? But is there a team which will carry through? And what is the credential of the team? It's not just some random people coming together, but they may have, again, linked to the unfair advantage, some sort of expertise. Or that's why they say that second-time entrepreneurs, succeed faster, because they already have gone through the hoops and have networks, have understanding, and also have credibility to pull the things through faster. And of course, one key factor that everybody looks into: are you targeting large enough market? If everything else can be changed, whether it's a team or whether it's a product, but the market size that you're going after cannot be changed. It's the only constant. So you need to really understand that you're not going into such a niche that even if you execute so well and you burn some cash to acquire new customers, then at the end of it, the whole pie is very small. It doesn't really work. So you need to maybe look into your product or idea or whatever you're trying to do to target or to tweak in a way that it is solving a problem for a large market. If not immediately, then in future. So unique value, what needs to articulate it very well. A team which has credentials and complementarity. Is it a large enough market? And finally, which we covered in the previous slide, is it financially feasible? If all this is put together, and if nobody is going to make money neither today, tomorrow, or day after, even in long term, for models which don't have immediate revenues, you need to have a feasibility study based on certain assumptions that, hey, I can monetize certain aspects that I'm trying to do. So remember these 4 things, at least. If you are not able to articulate in your pitches, whether it's elevator or the whole one-on-one meetings, then I think you're going to be in trouble. So give yourself a mark that if you have covered these 4 things in your pitch or in your pitch decks, then if not, then you got to work on it. Give yourself 0 for now. If you go to next. And the next is about your team and traction. Now, they're linked because they are linked to execution. Now, if you have not, and a lot of people at this stage do not have a co-founder, for example, and I tell you that that's the biggest red flag of saying if you are trying to attract investors. It's so important. It's such a lonely and painful journey to be alone. It's not a sign. So a lot of investors actually look for a complementary, if not complementary, at least a team which has 1 to 2 co-founders, so that not only one person is the high form of risk. So you want to hedge the risk. You want to also see one person doesn't get burned out. So attracting a team is very, very important. And this also proves that if you're able to energize your co-founders, that it shows you are able to sell ideas. Otherwise, it's a lonely journey, somebody possessed with some passionate idea. So not many people are going to touch you apart from the fact that you have family and friends who may invest in you. And team directly correlates with traction. The traction is the key metric for early stage. If you're showing execution capabilities and you're gaining early traction, then you're able to get a lot of people enthusiastic around what you're trying to do. So show up to various people, have a good team, share openly, and transfer your enthusiasm not only to recruit the first few people, your co-founders. Once you do that, you are confident that you're able to even energize investors, which are important in your journey going forward. Yeah. So if you don't have a good team, give yourself 0 today or early traction. But otherwise, let's move on to the next slide. Now that's a very, very key slide because popular media, especially the startup media, always releases the new 60 million raise, 36 million raise. Raising fund itself has become a metric for most of the entrepreneurs who are entering this space. What I say is stop running after money and focus on the fundamentals of business. Once you do that, once you focus on team, the 4 pillars that I mentioned earlier, you are in a position then to choose your investor because you are the guys people are going to bet on. So if you have a good team, if you have a unique way of tackling it, you're tackling it for a large market, and you have a model that makes sense, then you're in a position to negotiate because a good founder, a good team, and a good product is equally a need for the venture capitalists and investors as much for a founder to find. So it's a team thing. It's not a power diagonality between 2 people. So don't run after money. Not to say that you don't need it, but there's a method to the whole thing. And you need to understand your own value and focus on creating value rather than just aimlessly chasing, funding, so as to say, as a metric. So if you have, if you don't know things like how much company shares or percentage, or is it convertible bond or convertible note or safe document, or what percentage can I give it to VCs at the early stage or to angels and then to VCs at later stage, then give yourself a 0 because these are very important things to learn at this stage before you start walking your walk. Otherwise, you'll just get lost in multiple documentation, negotiations, and jargon. So educate yourself onto how this whole system of angels, seed round, and VCs work. And I think for whether you're a tech founder or a non-tech founder, you cannot escape the fact that the whole business game is all about people. Now, people savvy, some founders is quite natural. For others, they're in their discomfort zone. But you got to move out of that. In today's world with social media, which is depicted by the internet out here, and the hard work that is inevitable in this space, and if you convert these two, converts to network. Your hard work and your internet is nothing but your network is your net worth. So you need to get out of your comfort zone. You need to learn things. If you're a non-tech guy, you need to get out and learn about some tech stacks. What is required? You have to hang out with people who talk tech language and perhaps learn certain things in even basic UX, UI, coding, and other aspects. So at least you need to know what's happening as a founder. But if you're a tech founder, then sometimes maybe at the cost of stereotyping, but it's found that you're not very comfortable with the commercial discussions or getting out there and really pitching pretty well to some of the investors. You've got to get out of your comfort zone to develop your people skills. This is very, very important because people are betting on co-founders or founders, and you need to be out there at various levels, whether you're recruiting a team, recruiting an investor, or even just be out there to energize for your company. So cannot run away from people. So develop those skills, even if you have to do some courses, or the best is to keep practicing. Be out there. Don't be in your den. And as Mr. Jobs famously said, one more thing, and the one more thing that we have to tell you about is in the next slide. And that's something which is a sobering thought. And why do I say that? Because a lot of time I meet young founders and it seems like I can escape my boss by creating something because I can create at a low cost today. And there's so much funding available out there. There's a whole ecosystem which is evolving. So it's pretty sexy to get sucked into the whole startup game. But do not think it's a sprint. It's a marathon which feels like a sprint every day. And not many people will tell you that, but I can tell you that if you're signing up for that, be ready with the stamina that you can sprint every day, but like a marathon. It's a very long journey. Success is not guaranteed. Success statistics are not in favor. So only brave should dare to do that. But at the same time, I say it's best time to be alive. You can do whatever you want to do for the first time without, there is an ecosystem, there are tons available for people who have great ideas and who have capabilities to be walking the walk and not give up. So only thing I'm trying to say in this slide, both messages, is do not have misplaced expectations. Need to know the reality. And if you're signing up for that with your family, with your friends, with your own credibility, then be aware. It should be a mindful decision. And then you stick with it. Be persistent. All right. It's not just a one-trick pony kind of a thing where in 6 months, 1 year, you will create something, somebody will buy it, and you'll become a millionaire. This doesn't happen. Very rare. So all the best. So this is the score time. I hope you have marked yourself on all these slides. I guess if it's less than 4, I would say, hey, go back to your den, rethink, relearn, and reboot. And there are tons of resources. Firststop.sg, as we just launched, is aiming, for fundamentals of idea to startup in 30 days, connecting you to various things. And at each stage, it fits in. Less than 4, you will learn a lot from the e-learning course that we have and some workshops that we do at the end of it with experts. 4 to 6, if you are, don't quit. If you are in a career, don't just pay somebody $30,000 to create a platform. Moonlight, keep working if you're working. If you're not working, just work extra hard to validate your minimum viable product first. Get out, talk to a lot of customers. And if you're between 7 to 9, there is tons happening in the ecosystem, whether it is, whether they are, you go to Block 71, figure it out, go to WeWork, there's so many other co-working space, connect with different founders, learn from their journeys, self-study, but connect with the ecosystem because there's a lot of randomness today and it's inefficient, but there's no other shorter way apart from, learning from platforms like ours, as well as just going out and connect with the ecosystem players. And if you have 10 and all this stuff, hey, what are you waiting for? You are a perfect 10. You go out there and pitch, meet the customers and pitch to potential team members and investors. And then what are you waiting for? I think you're ready to go and live your dream. So I hope it was helpful to understand the basics. But again, it's targeted at people who have idea and who are either at the idea stage or just creating MVPs. And if you can follow this, I think it will help you get a little bit of a sanity check there. And once you're ready, once you have 10 on 10 on this, then you go out and platforms like Startup, many seed stage funds or even angels are available for you to take you to the next step.
Also, thank you so much, Anuj, for that. I think it's definitely extremely helpful for everybody who's listening, as most people are startup co-founders themselves or founders. It's really useful just to have like a checklist from somebody who's been there and who sees the ins and outs and obstacles and challenges that startups often face, and having something to refer to know where they are and where they might need to work a little bit. So thank you very much.
No, my pleasure.
So during the talk, obviously everybody will be scoring all over the place, but there's some jargon that was used that I just want to make sure that everybody is familiar with, for those that maybe score zeros, so they don't feel discouraged. So in the beginning, you're talking about running lean. What does running lean actually mean? Because we hear it a lot. It's a big buzzword these days. So maybe you can just enlighten everyone a little bit.
So when you go hiking, the advice is to travel light, because you're going to get burdened by your own baggage. And that's what I think is the essence of running lean, which essentially means that, I'll just give you an example of when I was working with large FMCG companies. We used to conduct focus groups if you have to launch a product. And we go out and, have hypotheses, have different tests, and then we'll, do research. A lot of times, so from day zero, when we have when we have a hypothesis, to the time when the product is launched, it will take, maybe a year plus, but we lose touch with the reality, and you're committing your resources first, hoping that it's going to work out after the launch. This was a old methodology, still applied by many companies, but in the technology startup world, where you don't have too much resources, you don't have too much time is your currency. The whole idea is to have an iterative methodology, which essentially means you go out there, check whether you're really solving a problem, whether your solution is really attractive, and you have a unique value or not. And there is a whole way in which you can conduct these things without incurring a lot of cost and wasting a lot of time, and then keep pivoting to, or keep incrementally improving your solution as it moves on. So keeping the cost and keeping the burn pretty lean in that fashion. It starts with, having the whole plan on one page, as we saw on slide one, but it's more with the intent that it is not about creating. It's not about having every frill and fancy and the right from the colors to all features in your product from day one. And then you see the light of the day, and then you realize, oh, either the market is shifted or the customer is not buying, and then you burn everything down to grounds and again start. So to survive that pain, it is quick iterative process and constant learning that I think is called lean.
Yeah. Thank you very much. I mean, definitely very true. And it's definitely something that's very big in startup communities, and now is also being moved to larger corporations, of those short, quick, iterative learning processes that really help you keep kind of a pulse, or check the pulse of what you're doing and who you're marketing towards, and if it's actually, like you said, solving a problem, and if it should be built. So you touched on a very interesting point, which is traction. And how important traction is to show for VCs for investment. Other than paid customers, what are some other ways that a company can show traction? Can they show it through, social media and engagement? Can they show it through, surveys they've done? Or are there any other ways that they can entice VCs or investors to show that, they do have
the metric idea that you Sorry, but I'm saying it goes back to the metric that you've chosen. And totally differs from a business model to another business model. So there's no one answer that fits all. But the whole idea is, whatever your metric is, you need to be able to show that it has moved from week to week, if not month to month, right? So, like, for something which is based on more website visits and app downloads and all this stuff, you need to really grow very, very fast, because if it's a free offering in that scenario, right? So every week you need to track whether the hockey stick is forming or not. But if it is more B2B sort of a model, then you need to really understand how many letter of intents are coming in, or how many meetings have gone in, what stage. So it's a whole pipeline of your segment, like, warm leads to, like, a typical sales funnel needs to be showcased, that how many people are allowing you from cold call to meeting. That's also a sort of traction. If your conversion rates are improving, if you have a foot in the door, then how many are actually, are you reducing the sales cycle? How many calls are getting converted into even POC, if not the final contract, and so on and so forth. So it depends on the model. But the idea is, whatever metric you choose, are you showing the growth on week-to-week basis, and you have to track it in first place.
Very important to track and know what metric you should actually also be tracking. So along with traction, you mentioned team, and you mentioned that, a single co-founder is a bit scarier for investors than having two. In your mind, when should a founder focus on finding a co-founder rather than focusing on their idea? What is a good number to start with for a small startup? Do you just need two co-founders? Should they also have, like,
I think one more. at least one more, so that you're not, you can have a beer when you get slaps in the day. You go out and just, share with someone. So I think two is the minimum, and ideal is three, of course, because, and they just say, the folklore is the hacker, the hipster, and the hustler. So you need to have, this is the ideal one, as they say, but I think there's no hard and fast. I know companies we invested, we have 5 founders, and we also invested in with 2, but at least you should have another one. That's my feeling.
Wonderful. Thank you, Anuj, for all your tips and insights today. They've been extremely helpful, I'm sure, to everybody who's listening. So that's all that we have for today. Thank you, everyone, for tuning in to today's session of Inspire. Until next time, be inspired.